Hello everybody, welcome to this webinar where we'll talk about leading indicator forecasting and if this technique can be useful in case of a black swan event like the coronavirus outbreak. With me in the webinar today are Bram de Smet, CEO of Solventure, and Gillian Verstraeten, PhD researcher on the topic of leading indicator forecasting. And my name is Sarah Timmermans. I'm responsible for business development at Solventure. On the agenda for today, we will start with a general introduction on what is happening today, the macroeconomic impact of the coronavirus outbreak and why we are interested in this topic as Solventure. We'll also take a look at traditional statistical forecasting techniques and what you need to pay attention to if you are using these today. Then we will show you how you can assess the impact of the virus outbreak on your business and how leading indicator forecasting might be of added value. And we'll end with a summary of how you can take this all into account, some practical advice. And please see this as a brainstorm together, because of course nobody has a crystal ball. I think we're all wondering what the impact will be and how we should handle it in our processes. So see this as a brainstorm to exchange experiences together. Okay, let's take a look. Our question for today is, what is the impact of the coronavirus, or how can we assess the impact? If you look at this snapshot of the state of the virus taken end of January, and if you compare it to a snapshot of this week, then of course it's clear, we all know it started in China and now it's spreading more and more around the world. By the way, this map by Johns Hopkins is an interesting data source if you are looking for integrated data or real-time information about the virus cases. And then if we look at the economic impact, we see, of course, different signs. We see various companies warning about their upcoming results, adjusting outlooks downward. Apple warned us that their supply will be hurt, that their manufacturing partner in China, Foxconn, is facing a production delay. The oil price is and the oil demand has been affected. And then we also see, of course, a huge impact on the economy in China, like a huge impact on car sales, for example. And then, of course, next to that, we also are seeing some impact already in the rest of the world from companies having issues with supply from China. A lot of factories were closed. A lot of them in the meantime have been able to restart, but there are still logistical issues because of border controls and travel restrictions. Some car makers like Nissan and Hyundai temporarily closed factories outside of China. And then, of course, also for the US, with the Federal Reserve's emergency rate cut this week, the message was also that the recession cannot be ruled out. So I think we are all with a lot of questions, facing a lot of questions like, how will we now take this into account in our forecasting processes? For people that don't know Solventure yet, in this call, we are experts in the S&OP process and European channel partners for the Archiva S&OP software that is also listed in the Gartner Magic Quadrant. If you look at the 6 steps of the S&OP process, at the core, of course, there's the supply, inventory, demand balancing. and that is basically we are in the business of making companies better in balancing that demand and supply with a strong element in analytics, because we strongly believe in analytics-based decision making. So it's clear that today, with the news updates that we face every day about Corona, we are unsure what the impact will be on this balancing, and we are wondering how we can take that into account in our forecasting processes, in our S&OP process. So this is, of course, a subject that we are very interested in. And on top of that, we always pay a lot of attention to a balanced approach, process, people, tools, and analytics. And we believe that analytics or data-based decision-making can be a turbocharger in the mix. And that's why we have also been investing couple of years now in leading indicator forecasting, and of course in the projects that we are doing there are also a lot of questions on how to handle the impact of the coronavirus, of course. So for the topic of today, let's take a look how we can take it into account in our forecasting process. Maybe just one thought. Again, I invite you to see this webinar as an exchange of thoughts, as a brainstorm around the topics to see if we can exchange experiences. One thought that I have been discussing already a couple of times with people is like, yeah, but you cannot predict something like the coronavirus, right? There's no way you can predict that. And indeed, there's one certainty in life: a forecast in general is always wrong. And on top of that, indeed, a black swan event, something that happens once in a lifetime or very seldomly, is unpredictable on top of that. So why should we bother trying to predict it? I think there are two important thoughts to consider. One, a forecast is wrong, but it's not necessarily useless. It is very useful to make a prediction, to bring together all information that you have available in the company and to discuss about maybe even potential scenarios. What will we do or what should we do? Suppose the impact will be X, or suppose the impact will be Y. And a second thought is also that we are not trying to predict the black swan event in itself. We are trying to predict the impact on our business. And there might be some value in the leading indicator forecasting techniques. So let's take a look at the next part of the agenda, the traditional forecasting techniques.
Yep. Thank you, Sarah. Well, as Sarah says, for a couple of years now, we've been working on leading indicator forecasting. And I think this could well be the moment of truth for leading indicator forecasting. And why is that? Because I basically want to take you through how traditional statistical forecasting works and behaves in these types of situations. And it will be clear that traditional methods do not help. On the contrary, they are quite problematic at this moment. And then Gillian will introduce how leading indicators can be used to get more grip on the situation we are all currently going through. So how does traditional statistical forecasting works? Basically, it extrapolates the trend. So if I look at this time series here, I see an increasing trend, and either I take the long-term trend, that's the red curve on the bottom, or I take the short-term trend. The short-term trend seems to be a bit more steep, but in any case, if this is the economy we have behind us over the last couple of months and years, an economy of growth and consistent growth, with many of you, the current statistical forecasting models will simply predict an increase over the next few months and the next quarters. Yeah? Whereas we all know that this is not going to happen. Right? So we know this will not happen, and still this is what current forecasting methods in our existing tools are spitting out. So what happens is, okay, at some point in time, we will see an impact on our sales. So we see our sales volumes declining. What do traditional methods do at that time? Well, all of a sudden, instead of predicting an increase, they will just extrapolate the decrease. So what we will see, let's say in 2 months' time, for instance, in European figures, is that, okay, European output is lower than expected, and traditional methods, if you use the short-term trend, will basically start extrapolating that all the way to the bottom, which is not necessarily very helpful either. What traditional forecasting literature or methods would say is like, okay, in this type of periods, we resort to the expert. So with our collaborative process within the company, we will ask the relevant people in the company what they think the sales will be over the next few months. So we will not necessarily rely on the traditional forecast or the statistical forecast, but we will rely on human judgment. While that is nice in theory, many of those experts currently don't have a clue either. So many of you are experts. If I ask you as an expert, so what do you think your forecast will be for the next few months? You don't have an idea. Why? Because there's not really good contextual information which would help you with this. And what do we then typically do as humans? We have a short-term memory. So what I expect is that if you look at the consensus forecast in many companies, well, also the consensus forecast by human judgment will basically extrapolate the recent trend. So as soon as sales starts decreasing, that's what we will extrapolate towards the future. So whether we rely on traditional statistics, whether we rely on human judgment, this is the change we expect to see in many of your companies over the coming weeks. That is that instead of having an increase in the forecast, all of a sudden we will start seeing a decrease. If we just extrapolate downwards, well, we know at some point in time the situation will stabilize, and we might even see a kind of a boost again, a recovery. Here again, if I'm not able to predict trend changes, just a trend, I will be too late, because at some point in time I will see a kind of recovery, and if it's not in my forecast, I won't have the material to supply. So going forward, we know that at some point in time this is going to bottom out, or either we see a kind of a recovery, not really to the level of before, but to a decent level, or are we going to see a recovery really to the level we were before, or are we going to see a recovery which is even going beyond, because maybe we recover some of the lost sales during that crisis period. So being able to say more about this is crucial to navigate your business through this change the coming weeks and months. And what I basically try to introduce so far is that traditional statistical forecasting is not helpful in this. Actually, the information you get from it is misleading. It doesn't mean that the traditional methods don't have value, right? They can still help you to predict the mix. They can still help you to predict the short-term trend and the short-term volumes, but you should not use a traditional statistical forecast to predict trend changes, because it's simply incapable to do that. And a last problem many companies will have in the coming months and actually the coming years is that, well, we all know that our historical sales will be affected soon by that corona effect. And if we don't clean up our history, we will always have a kind of a dip, which will keep on influencing our statistical forecast. And if I don't want to see that, I need, in many situations today, I need to manually correct that sales history to kind of manually exclude that corona effect. But that's, for me, really artisanal, right? There are way more clever mathematical techniques available today. There is way more data available today, so that companies can do this in a much more professional way and address all of the issues with the traditional statistical forecasting that I've just described. And the way to do that is using external context, external macroeconomic factors, and basically that's what Gillian will explain to you.
So indeed, the next part we will assess how we can, or we will discuss how we can assess the impact of the coronavirus on your business. So typically, well, actually, Sarah already mentioned it. We have developed a product. It's called Solventure Live. It's built on advanced predictive analytics, and it's built in coordination with universities. It's been the subject of PhD research, including my own PhD research. And the goal of the tool is to include external factors into the strategic and the tactical sales forecasting process. So what can these factors be? Well, on the right of the slide, you can see an overview of many of those factors that can influence the sales. So it's relevant for the coronavirus. Typically, there's an event influence. So there can be an event. Corona is an event, a black swan event that impacts the sales. But it's also an event that can be seen in the macroeconomic indicators. So that's what we're going to discuss also today. The goal of this tool is twofold. So the goal is to increase forecast accuracy by seeing the turning points in the sales ahead of time. And the goal is also to gain insights in what is actually driving your market and your business. And in order to do this, we have gathered an enormous database. Right now, it contains more than 10 million indicators in total. So we gathered information for example, the Federal Reserve, which is a database of the United States. We have gathered information on China from the National Bureau of Statistics of China. And we have also gathered a lot of information on Europe of the Eurostat. So what is typically the goal in leading indicator forecasting? So imagine that the blue line is your sales. Then typically, Bram has extensively discussed this in the webinar. The traditional statistical methods, they will simply extrapolate your sales. So what will they do? If your sales has grown for 5% over the past 2 years, then for the next year, they will also predict a 5% increase. However, if a turning point is happening in the sales, then this will lead to a huge forecast error. So what is actually the goal there? If we can explain the underlying business process which drives your sales by using, for example, leading macroeconomic indicators, then we can see those turn points coming ahead in time, and we can improve the forecast accuracy in those turning points. How do we do this? Well, we are looking for indicators which are leading on your sales. So typically we are looking for indicators that are leading between 1 and let's say 15, 18 months on your sales. And this leading time, this will offer you knowledge on what is or whether a turning point is coming, yes or no. So this slide shows you the leading process, but this leading process, it can consist of many indicators. So the leading time of this leading process is determined by the indicator with the minimal lag on your sales. So this all sounds nice in theory, I guess, but the question is then, can we already see impact in macroeconomic data? And the answer is actually yes. So what do we see? Well, especially in the China data right now, in January, we had Chinese New Year. So by default, a lot of factories were actually closing during this period. So nothing is really happening of significant interest there. However, in February, that's when the Chinese government started to quarantine cities in China, started to do travel restrictions between cities in China, started recommending workers to stay at home in China. Well, then of course you can imagine that this has a huge impact on the economy. So what are the things that we already see? So if you look at the PMI data of China, so for the ones who are familiar with this indicator, the PMI is some kind of a survey that is sent to a lot of companies. And the companies have to suggest or indicate whether they see an increase in production, whether they see an increase in new orders, whether they see changes in raw material inventory, in employment, and in delivery times. And based on the responses of those companies, an indicator is composed. And the indicator basically says, okay, if it's 50, then equal amount of companies suggest that there is going to be an increase as that there is going to be a decrease. So you can see since 2014, this indicator has been swinging between 52 and 49, which is not very significant swings, of course. But if you look at the value for February, and this is where it gets really interesting, it's really off the scale. So it's 35.7 for February. So that's for manufacturing. What do we see for non-manufacturing? So for non-manufacturing, the range is a bit somewhat larger. So you can see that it ranges between 56 and 53. So over the past 6-7 years, it has been steadily increasing. However, for February, this number was 29.6, so another very significant drop here. So let's look at car production. So car production has been ranging from 1 million vehicles a month to actually 3 million vehicles a month in China. Sarah already mentioned this. In February, car sales have fallen with 92% in China. So that's going from 2.5 million to 250,000 vehicles. Well, this is production and the other one is sales, but indeed, as you can imagine, changes in sales will lead to changes in production. This is also something that Sarah has already mentioned in the webinar. So the Federal Reserve. So this graph shows you for each date since the beginning of the year what the market was thinking the Federal Reserve is going to do with interest rates in the US. The interest rates since the beginning of the year have been in the range of 1.5 and 1.75% in the US. As you can see, it has been this up to the expected interest rate in the US was with a 90% certainty that these rates were going to remain unchanged during the month. Even during the month of January, it seemed like rates were more likely to increase instead of decrease. However, we've all been following the news, of course, in the last week. The Federal Reserve has acted and has, even before this meeting, changed interest rates quite drastically with 0.5 percentage point. So you can see from February, the expectancy that one rate cut, so a 0.25 percentage point cut, was more likely. But then in the last week, actually, the chances of a 0.5% cut just drastically went up. So that's what we can see in macroeconomic indicators so far. Actually, if you look at this graph today, then it suggests that the next meeting, so that's mid-March, there is likely to be an extra cut or an extra double cut. But we've also seen a lot of trends and changes happening in commodity data. So what do we see there? So we see changes happening in the copper price. You're probably asking, yeah, copper price, why is this important for my business? Well, copper price has been quite well known to be a good predictor of the overall economy because it's used in many things in industry. So it's used in electronics, it's used in construction, it's used in automotive, it's used in consumer products. So from the demand side, it's quite a broad indicator and it spans lots of industries. Also, the supply risk for copper price is quite low because the mining of copper is well dispersed over a lot of regions in the world. And in this indicator, we see that since mid-end January, this has been quite a huge drop of 5% in copper prices. The next commodity price where we saw some changes is the oil price. So also oil price is very broadly influenced by, from the demand side, by the global economy. So here it's the same is visible as with the copper price. So you see that there has been quite a significant drop, 17% in February. However, oil price is a bit more dangerous indicator in that sense, because it's also influenced from the supply side, right? So the OPEC, if they decide to reduce oil production, then of course this also has an effect on the price of oil, which will increase. And also it's quite a geopolitical, less dispersed indicator. So a lot of those oil producing countries, they are in the Middle East, and that's typically not the most stable region in the world. Another indicator in which we saw change is the gold price. So gold price has been for investors for quite some time a safe haven. So if the economy was going into a period of uncertainty or a period of recession, all investors, they flock to oil. Well, what we can see here is that the gold price, it actually increased with 12% over the last 2-3 months. The final indicator which we're going to discuss is the Baltic Dry Index. So the Baltic Dry Index gives you some kind of a quote on how expensive it is to ship goods overseas. From the supply side, this commodity indicator is stable. It takes a lot of time to build ships. So if you order ships, it takes typically more than a year to build a ship. So from the supply side, very stable indicator. From the demand side indicator, the global economy, if you want to send goods from China to somewhere else in the world, then you need boats or ships. So you can see that over the past months, this indicator has actually reduced, but is reduced to 30% of its original volume in December. So we've shown you a lot of indicators which can impact your business, but the question is, do you already see an impact on your business yourself? And you can fill in this answer in the question box of the webinar meeting.
Another person says, we are also seeing an increase in sales to other DCs. Yes, and then another person, yes, we ship more protective equipment to missions, because that's from Doctors Without Borders. Yes, and there we also have, of course, an interesting challenge about getting the right supplies for that, of course.
So now we'll show how we can model this in our leading indicator forecast tool. So to model the sales with leading indicators, we have this process in place. So the first step contains of building an indicator set. And for this step, we combine the input of 2 sources. So we usually ask our customers, they have experts on the business in-house, so they probably know best what is driving the business. So we will typically ask the customer to build a fishbone diagram in which they structure the drivers of their sales. And this will be used to get some keywords which can be used later in an indicator set. We also offer a brute force analysis in which we will check the correlation between many indicators which are in our databases with your sales. Typically we will see, well, correlation is good to identify what has a primary correlation on your sales. But typically a model consists of more than one indicator. So it's good to use as an input also for building an indicator set, but it's not something that can stand on its own.
And maybe some practical advice, what you can do, what we typically see in companies about the expert input, that in different companies it's in different divisions. So in some companies, finance does some modeling on leading indicators. In other companies it's in marketing. In other companies it's in supply chain, the demand planner experiments a little bit with it. So I would say maybe some practical advice is to put different representation of different functions together and discuss about, make a fishbone diagram and discuss about what indicators are an input, a direct input on your business, and then check if those indicators are already impacted by the coronavirus.
Mm-hmm. And also, a good point is, if we do a correlation analysis with millions and millions of indicators, then a lot of indicators, of course, will pop up that do not sound naturally to you. So that's important to filter this out, because you do not want your sales to be forecasted with some indicator which you do not understand. From our side, it's also very important that the model sounds or feels natural to the user. So we combine the input of both sources into one indicator set. For this, you can use our indicator cloud, which we have built for searching indicators. When we have built an indicator set, then you can use our leading indicator forecasting technique to select indicators. So from the set that we have built, you can use the indicator statistical model that selects the indicator. But also here, typically we see correlation does not mean causation, of course. So typically that's some kind of an iterative process for us. Sometimes some indicators can still be selected, maybe with a non-intuitive relation, which means that the reversion, the relation is inverse to what you would expect, or the time lag is not very intuitive to you. So by this iterative process, we really can come to a model that you can understand, and that's really important. And then the final step is the integration of the forecast model in your forecast processes. You can build the best model that you understand, but if you do not know how to use it in your forecast process, well, then it's quite a useless model. So for us, that's also very important. So we've seen in the model that we just showed that, for example, the oil price is in this model. But what we also expect with the coronavirus is that the impact can happen quicker. You saw for this steel case that the impact was only after 6 to 7 months of the oil price, because it's a black swan event. It's unpredictable, and it creates some panic in the market. It could be that that companies they will change their production quicker. So that actually the influence of the coronavirus and the oil price changes will happen quicker than what is expected right now.
Yeah, so from that perspective, I would recommend to also take a look at your order patterns and your order behavior. But we're definitely interested to brainstorm and to exchange ideas at the end of the webinar. Yeah.
Another food for thought is actually due to the coronavirus. What we typically model with leading indicator forecasting is changes in the demand side. So changes into your business environment. If you're in the tire sector, then increasing mileage of cars will lead to tire wear and to replacement of the tires, for example. But what might be happening with the coronavirus is that there's a supply constraint. So goods that you were expecting or needing for production might be stuck in China because of lots of things are happening in China right now. companies are quarantined. There's travel restrictions. Workers are not coming back to the factories due to fear of the corona crisis. So it could be that there's some supply constraints which will also impact your shipments of your sales.
And if I just may add there that that's why that S&OP process, as we as Solventure implement in companies, this is also a moment of truth for S&OP, because you want to have the best possible view on your demand. And okay, this is a challenging situation, but not looking at external information is certainly not an option. So you need to use the information you have. And also in the S&OP, it's not because you think you can sell 100 that you will be able to supply 100. So looking at that supply side and balancing supply and demand, that's a crucial process to steer on in the next few weeks and months.
Okay. And the last food for thought is indicator versus event. So we've seen a lot of indicators are impacted by the virus outbreak. But it could also filter out the event and quantify it by using event modeling, which is also something that is possible in the leading indicator forecast tool. Typically, there's some considerations there. Downstream in the supply chain, you're much closer to the end demand. So there it could make more sense that you do event modeling over using an indicator. If you're in Europe or you're in the US, for example, then you could, if you also have sales in China, you could capture by event modeling the influence of the coronavirus in China and transpose this effect to Europe or to the US. But the question is then, of course, will the impact be the same? Right now we see also a lot of things happening in Italy, quarantine measures and so on, and so it could go the same way, but maybe it could also not.
Well, at least analyzing today the situation, so that's the discussion we also had last week. So in January, we don't see a lot of impact because we already had Chinese New Year. The data for February basically started coming in last week. So we are now screening the Chinese data of February and learning from that, and then being able to run a couple of scenarios like, what if we see the same effect in Europe? What if we see the same effect in the US? What if the effect comes quicker? At least you have a quantitative way to analyze the situation and become smarter. So I think that's where today, that's the type of discussions we today have with companies which are using the tool and which have engaged with us to improve their forecasts and with using this method.
Then some practical tips for handling the corona impact. So what we always suggest to companies is to segment based on local and global effects, right? So what you should do is you should segment based on the type of industry that you deliver to and based on the geographical location which you send your products to, because the demand patterns in those regions or in those industries, they of course follow different underlying processes. Then we suggest that for each of those segments, you determine which indicators are leading for your business. So that's something that we can definitely help you with. And then also you want to determine the impact on each of those segments. The impact of the coronavirus can be different depending on the region, depending on the industry, even depending on the end market it goes to. For example, if you're in the tire business, it could be that the OE, so the sales to car companies, is much more impacted than the replacement, right? Because the purchase of the car, maybe the factories of the cars, they are blocked. Purchasing a car is typically a bigger investment than buying new tires for your car. So each of those segments, they might be differently impacted by the virus outbreak. The third thing you want to monitor is the impact of the virus on the used indicators. So we've already seen that there's a lot of indicators used in forecast models. We see oil price being used a lot in companies. We see interest rates being used a lot in companies, which are definitely impacted by the virus. And you want to keep on monitoring this, of course. If you can see when it starts dropping, you also want to see when it starts to increase. The third step should be to quantify the effect of the virus on your demand. So you want to filter out the effect of the virus either by using events or including indicators. So this can mean that for existing customers, your models might need recalibration based on the coronavirus. You could try to look at the impact of similar events in the past. For example, in China, there has been a similar outbreak of a coronavirus, which has led to similar symptoms, actually. And you could try to mitigate the influence of China to the US and to the EMEA region. A fourth step that you can take is to monitor the order behavior. So if something happens into your future orders, then this can mean that there's changes about to happen in your sales. So that's really the moment that you should watch out. So there can be a slowdown, or it could be when things are picking up again. What's also really important is the understanding the cost of overreacting on the virus outbreak and totally panicking in your firm versus underreacting. So those costs, they can be different for each firm. And the final step we recommend to take is take your time, especially now for the SNOP process. So we see that sales, they get a lot of information from customers. Marketing, they get a lot of data, so they can probably see what is happening on the longer term, maybe than what the sales can see. And also supply chain can add a lot of value there, because they know whether there's going to be supply issues in the future, in the near future. And the thing is, put all the information together and so that you can come to the best possible situation.
And for people already using leading indicator models today, we should consider recalibrating, but that's related to advice number 3, you said?
Yes.
Okay. Yep. Okay. Yeah, I see there's a typo on this slide. So the question should be, what steps are you considering to take? Maybe we can show the previous slide again to the audience. Let's exchange thoughts, let's exchange experiences, because in any case, I would think that most of the companies are working with a traditional process with the statistical baseline and the collaborative aspect in the demand planning process. So what would you recommend to peers to take into account in your process today? Any suggestions? Okay, there's a comment. We already planned all orders for the upcoming months for Chinese suppliers. Makes sense?
Yes, if they can deliver them.
Yeah.
Yeah, my question would then be, if you plan today for the next few months, based on which assumptions, right? So is it for European demand, is it for US demand, or is it for local demand? And what are the underlying assumptions in the forecast? So if we are too optimistic, we might have a lot of raw material component inventories which will consume cash, or inventories could increase. If we really see a slowdown in demand, we will have enough raw materials, but maybe way too much. And we will have capital sucked up in the inventory, which is difficult to free up.
Yeah. There's another comment. Determine the impact of transport restrictions whilst having a stable demand nonetheless.
Yeah, so I think it's another comment which confirms that I think today in Europe, the biggest problem has been we don't get material from China. So that's how I read it, which for sure means that from a European perspective or mindset, we are still in that stable demand scenario or potentially even a growth scenario. And our main issue so far has been on the supply side. And at the same time, if we see the impact on the Chinese economy today, it would be very surprising that we don't see a similar effect on the European and the US economy. So my question remains in the S&OP process, looking for the next 2 to 3, 4 months, what is our demand scenario and by how far will we buy raw materials for the original demand scenario, or will we start buying for a reduced demand scenario? That's the type of discussions I would expect in S&OP meetings today.
Yeah, indeed. There's another remark. Since 2 weeks, we are centralizing all supplier-related information containing info on shortages, difficulties. This information is then verified with a critical item list, like the protective equipment, and communicated through channels with missions. Yeah, makes a lot of sense. We all know it's always a challenge to get information around in the company. So it makes a lot of sense to centralize information and communicate updates. Makes a lot of sense. And also a comment, we are deciding to overstock certain products for potential emergency scenarios. Yeah, makes a lot of sense. And I think in your scenarios, I think it's also worthwhile to take that into account in general, that people will increase buffers. We already see it in consumer behaviors in retail as well. Following actual orders sound logic, but isn't that more demand-driven planning logic? Or can that help to identify the move in lack of the indicator in use? Yeah, that's correct. I think it's indeed monitoring the demand-driven part. Yeah.
I think where demand information can still be leading, because in a certain sense your orders is not a leading indicator, it's an incident indicator. So if I only see my orders going down today, or by the time I see my orders increasing, probably I'm too late to react with my supply chain. What you could try to do is, if you say normally in a lot of business to business companies, by the second or the third working day of the month, it could be that typically you have 70 to 80% of your orders. So monitoring how the demand progression looks like can make sense. Typically the second or the third working day in the month, if you have received significantly less orders than anticipated, then the whole month will be significantly less. So it's not an indicator which learns you a lot over the next 2 to 3 months typically, but certainly for the running month and for the shorter term. So that's more short-term demand sensing, you could say, than the mid-term demand sensing.
And then another comment again about this, and on the previous comment as well, the question is maybe the order monitoring can help to identify the move in lag of the indicator in use, that there might be another reaction time in the lag that we typically see in the indicator that we know that has impact on our business. That makes sense, right? And then maybe another final comment. It's actually the other way around. We are expecting a stable demand situation continuing forward. However, with possible transport restrictions, how will our supply adjust? That's indeed the supply side that will maybe even have an equally severe impact indeed on the demand side. I think we will need to take into account both, and at least also run some scenarios on the supply side, right?
What we've seen in the financial crisis, 2008, is that I expect that there will be a slowdown over the coming months, as well in Europe as in the US, and that we will see that earlier in China, but also in China we will see the recovery earlier. So my expectation
And
is
maybe
that
quicker recovery even.
that will create some kind of bullwhip, meaning that there is now a shortage in the market because some Chinese suppliers cannot supply. So companies will try to buy whatever they can, to then realize 1 or 2 months later that maybe they bought too much, which will again result in less demand than, for instance, for the Chinese suppliers. So we will go through a period with quite some uncertainty. And what we saw in the financial crisis is that if you really go deeper, if the impact would be severe, that then certainly we typically wait too long to put sufficient buffer stocks to capture the revival. So monitoring on both sides, on the demand side and on the supply side, what the situation is, and almost trying to do a continuous rebalancing. And instead of, in a normal situation, you don't want to do the S&OP process too frequently because it can introduce nervousness. But at the same time, we are now in a situation that we need to be very agile and that we need to be very reactive. So it might even be an idea to almost on a weekly basis now evaluate the situation and reassess whether the assumptions that were in the latest demand and supply plan are still realistic, and whether one of the two needs to be adjusted. And that's
Yeah, makes a lot of sense. Okay. Thank you everybody for joining the webinar. And as I said in the beginning, please continue to exchange thoughts, to exchange experiences, to exchange information, and good luck everybody with the challenges ahead.